Good day everyone. So this is our interpretation and results to the Marathon Company. So this is the balance sheet of Marathon as of December 31, 2020. In this financial statement, we get the cash and cash equivalents and total liabilities to compute the enterprise value. Next is the income statement. So here we get the EBIT, EBITDA, and outstanding shares. The EBITDA and outstanding shares are given. Then we get the EBIT by subtracting the COGS and expenses to the sales or revenue. So here we see the income statement is net loss, of which it indicates that the cost of the company exceeds than the revenue. It is because the pandemic hit at this time, and this company is the most affected in pandemic. So next is the computation of enterprise value and equity value.
So the first activity is computing for the enterprise value and equity value. First, we compute the enterprise value by using the formula of share multiplied to the number of shares plus total debt less cash. So Marathon Oil Corporation has a share price of 6.67 and we multiply it by the number of shares, which is 792 million. So we have 5,282,640,000 and we add the total debt of 7,400,000,000 and less the cash of 742 billion, so their enterprise value is 11,940,640,000. So this amount is the measurement of their company's total value. As we all know, enterprise value is the mostly used by the investors and analysts to know the calculations of a company's value. The 11,940 million 640,000 is the measurement of their company's value. It also includes the market capitalization of their company and the short-term and long-term debt as well as the cash in their balance sheet. Next is we compute the equity value. We compute the equity value by multiplying the share outstanding to the market price, so 792 million multiplied to 6.67, we have 5,282,640,000. If we compare this to its previous year, their equity value decreases. It indicates that the liabilities of Marathon Oil Corporation this year increases than their assets. As we can see in the figures, the enterprise value is higher than the equity value, and it is very common that the enterprise value is always greater than the equity value since the investors figures in factors such as companies' expected future earnings from their growth and expansion. They always tend to include in the value of stock certain factors beyond the liquidation.
So valuation multiples. So here we compute the enterprise value with the formula of EV over revenue, EV over EBIT, and EV over EBITDA. Then the equity value is the price over earning ratio. So the EV over revenue is equal to 3.85. So what this value indicates? So this value indicates that a low EV over revenue is what we call more attractive investment in a company. Also, it is one of the sign of the investors to invest because they believe that the future sales of the company will increase. So next is the EV over EBIT. EV over EBIT is equal to negative 14.49. So what this negative 14.49 indicates? So it indicates that the company has a high debt to a cash. Also, this negative 14.49 indicates that the company have experienced financial difficulties. So, next is the EV over EBITDA. So, the EV over EBITDA is results to 8.23. So, if the EV over EBITDA is lower than 10, it seems to be a healthy company. Then, the EV over EBIT will not be, indicates a company uh, will not continue its function. So next is the equity value with a formula of price over earning ratio. So the price over earning ratio is equal to or results to negative 3.6432. So this negative 3.6432 indicates that the company is losing money. So we concluded that the company is losing money because of the because of the environmental factors that the company are out of control. So that's all. Thank you.